20 years, over 5,000 trading days, one systematic pairs trading strategy. A backtest is only as good as its assumptions. Bad assumptions produce great backtests that fail in live trading. Before we look at the numbers, here's exactly how the backtest works. We'll be explicit about every assumption so you can judge the results for yourself. We've built each piece of the pairs trading strategy across previous videos. Screening identifies candidate pairs. Cointegration testing validates them. Z-score signals tell us when to trade. Now we connect all three into a single system and run it on 20 years of real US stock data. The system has three components. The first is pair selection through annual reconstitution. Every January, the portfolio rebuilds from scratch. No pair carries over automatically. The selection uses only data available at the time, market cap and prior year prices for correlation. No future information leaks in. From the US stock universe, we screen same-sector pairs with trailing 12-month correlation of at least 0.70. On average, about 5 pairs qualify in any given year. Some years, none qualify at all, and the strategy holds cash. Trades execute at the next day's close, so signals from one day's data can't be acted on until the following session closes. That's called mark-on-close execution. The second component is signal generation using Z-scores. For each active pair, we compute the spread using the hedge ratio from ordinary least squares, regression, and normalize to a Z-score. Entry happens when the absolute Z-score exceeds 1.5 at formation end. The spread has already diverged from its historical mean, so we're betting on convergence over the coming year. Short the outperformer, go long the underperformer. Pairs are held for the full calendar year. There's no mid-year exit on convergence. The January reconstitution closes all positions and starts fresh. The third component is portfolio management. Equal dollar allocation across pairs, with each position split evenly between the long and short legs. That's market neutral by construction, which means equity beta is near zero. No leverage. The key difference from a long-only strategy is that every dollar of risk on the long side is offset by a dollar on the short side. Costs matter more for pairs trading than for most strategies. Each trade involves 4 transactions: buy one stock and sell another to open, then reverse both to close. At typical costs, that's roughly 0.4% per round trip for a pair. If the average pair trade earns 1 to 2% gross, costs eat 20 to 40% of the profit. Then there's the hidden cost, cash drag. When the strategy can't find qualifying pairs, capital sits idle earning nothing. Over 20 years, 6 years produced 0 return. At average short-term rates of about 2%, that's roughly 12% in foregone risk-free returns that never shows up in the headline numbers. The backtest runs annual reconstitution across 20 years. Each January, all positions close and new pairs get selected from the current universe. Positions are held through the full calendar year without continuous monitoring or mid-year exits. Over 20 reconstitution periods, roughly 5 active pairs at a time. Let me show you how we select pairs using real financial data. The pair selection query runs once per year, in January, using only data available at that point. Here's the screen. We build a point-in-time universe, compute daily returns, then calculate pairwise correlations within sectors. Let me walk through the key pieces. The ranked stocks common table expression pulls actively traded US stocks above $1 billion market cap and ranks them by size within each sector. We take the top 30 per sector, which keeps the pairwise computation manageable while covering the most liquid names. The return CTE computes daily returns from adjusted close prices over the prior 14 months. We use a wider window for price data, but filter to the last 12 months for the correlation calculation. The A dot symbol less than B dot symbol trick in the main query avoids computing each pair twice and eliminates self-pairs. The sector join ensures we only compare stocks within the same sector, with roughly 30 stocks per sector across 11 sectors. This computes thousands of pairwise correlations. DuckDB handles it in under 10 seconds. The top 30 per sector cap and market cap floor keep the universe focused on liquid names and limit extreme size mismatches. The output is a ranked list of same-sector pairs. Each row is a candidate that passes the correlation threshold. From these, the backtest computes the OLS spread and Z-score at formation. Pairs where the absolute z-score exceeds 1.5 form the year's portfolio. From the correlated candidates, two more filters determine the active portfolio, z-score entry and the minimum pairs rule. The z-score entry filter applies at formation. The backtest computes the OLS spread for each correlated pair at January reconstitution. Only pairs where the absolute z-score exceeds 1.5 enter. The spread has already diverged from its historical mean. We're betting it reverts over the coming year. A pair with a near zero z-score is trading at its historical equilibrium. There's no divergence to capture. The minimum pairs rule prevents the strategy from running with too little diversification. If fewer than 3 pairs qualify, the strategy holds cash for the year. A single pair portfolio concentrates all risk on one bet. 3 is the practical floor for any meaningful market-neutral exposure. Not every year produces qualifying pairs. When the z-score filter and minimum pairs rule disqualify all candidates, the strategy sits in cash. That happens 6 times in 20 years. Those cash years aren't a bug in the methodology. They're the methodology working as designed, refusing to trade when conditions don't support it. Pairs trading backtests face structural challenges that filters and methodology can't fully solve. Survivorship bias is hard to eliminate completely. Stocks that went bankrupt, were acquired, or delisted mid-year disappear from the data. A pair selected in January might lose one leg to a delisting in June. Point-in-time data construction reduces this bias, but the historical universe of tradable stocks is always incomplete. Correlation regimes shift in ways the model can't anticipate. 2 stocks that move together for 5 years can decouple permanently when one company changes its business model, enters a new market, or faces a regulatory event. The OLS hedge ratio goes stale during structural breaks, and no static model handles these transitions gracefully. Short-selling constraints add another layer. Not every stock is shortable at all times. During crises, exactly when the strategy should perform best, borrower rates spike and some stocks become unavailable. The backtest assumes frictionless shorts, which overstates performance during the periods that matter most. Then there's the market-neutral paradox. The strategy's biggest strength, near zero beta, is also its biggest weakness. You don't participate in equity returns. Over a 20-year period that included one of the longest bull markets in history, that's a massive opportunity cost. That's the PES trading backtest framework. Annual reconstitution, z-score entry signals, minimum PES rule, and a cost model that accounts for transaction costs and cash drag. The pair selection query is live on cetaresearch.com. You can run it yourself. Link in the description. The full backtest code is on GitHub at Ceta Research-backtests in the pairs 05 backtest directory. The 20-year backtest results are in the next video, year-by-year returns, the 6 cash years that explain a lot, and the crisis defense that makes pairs trading interesting even when it doesn't make money. Subscribe so you don't miss it.